Radio Cayman in the Cayman Islands.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Money Sense, brought to you by the Cayman CFA Society. You have a treat today. We've got Georgie Loxton from Liberty Wealth. I'm your host, Adam Butler, representing the CFA Society, and also the Chief Investment Officer of Resolve Asset Management. Thanks for joining us today, Georgie.
Oh, I'm excited to be here, Adam.
Yeah, well, we've got I think what'll be a contentious and interesting topic to many listeners today, and that is a discussion about the recent pension reforms that were passed, specifically regarding the ability to withdraw funds from your Cayman Islands pension for use in, I guess, applying against a down payment of a house or maybe even paying off your mortgage. So why don't we start with exactly what was proposed and I think has recently passed, although we haven't been able to get full confirmation of that. So what did they propose? What do we think may have passed? And then we can maybe talk about the rationale that they've used for these new rules.
What we think has been passed is that the government have attempted to address the cost of living crisis in Cayman by looking at people's mortgages and specifically the higher interest rates. And what they have said is that people can pull from their Cayman pension to pay down or pay off a mortgage. And it seems that they've said CI, 50,000 per person, can be put towards a mortgage. If you're able to clear a mortgage, however, you can take 100 CI. So let's say you had 90,000 CI outstanding on your mortgage and you had more than 100 CI in your pension, you could take 100 CI and be done and clear your mortgage, or the 90, whatever the outstanding balance is. And that's per person. So if you're in a couple, you could take 100 CI per person and clear a mortgage that was up to 200 CI. Or take the CI 50 to pay down your mortgage, in the hope that that would bring down your monthly payments on your mortgage and therefore provide some relief for the current high cost of living that people are experiencing.
Right. And do you have a good sense of what the rules were before?
Yeah, so the rules have been changing because we had the COVID withdrawals where people could pull up to 25% of their pensions. So people have taken a lot from their pensions in the last couple of years, and some pensions have been completely cleared. If you had less than, I think, 10,000 CI, you could clear your pension during COVID. Caymanians will also have, for a long time, been able to pull, I think, and I believe this is the right figure, 35,000 CI as a down payment on a house. So that's always been possible. There are also laws in place that have been there for a while around your voluntary contributions. So there's a difference between the mandatory contributions that you have to make by law and any additional contributions that have been made either by yourself or by your company. And you are able to access your voluntary contributions before retirement. You can pull them as a lump sum when you retire, and you can access those along the way for generally one of three purposes, and that is to pay school fees or education costs, to fund medical expenses if you get yourself stuck with big bills there, and also for housing purposes. So voluntary contributions have always been treated differently to the mandatory, but this current passing of the law is 50,000 CI from your mandatory, for any contribution in your pension you can take to pay down your mortgage.
Gotcha. And the previous laws only allowed you to pull money from the mandatory portion of your pension for first-time home purchases,
yes.
Right?
Caymanian first-time. Yep,
right.
I believe
and this
so.
is for any home
yes.
that you might be
yes.
contemplating
and
purchasing.
it doesn't seem that this is across the board. It doesn't appear from what we can see that this is a Caymanian only. This is, anybody living in Cayman who has a mortgage and has a pension can pay off some of their mortgage with this new law.
Gotcha. So these are pretty dramatic changes. What motivated government to want to push through these proposals?
I think they've got themselves in a bit of a panic about the cost of living. They can see people are really suffering. A lot of people are really, really struggling. across all ends of the spectrum in Cayman. And of course, one thing is that interest rates here have gone up from, 3 and a bit to 8 and a bit or 9 and a bit even. And that's a really big difference. And the banks have been dealing with those interest rate rises in different ways. It seems that some people's payments haven't gone up. They should have gone up, but they haven't, in which case they're going to find themselves at the end of their mortgage term having not paid off their mortgage because they will not have paid down their principal. If they requested the bank to send them what we call an amortization table, they would see at the end of their 20-year or whatever the term is that there's a big balloon payment that they're going to have to make in order to have that mortgage cleared. Other banks seem to have been putting up people's payments along the way, and some people's payments have close to doubled in the last, a year?
Right, yeah.
So I think the government are trying to do something quickly. Then they're looking at pensions again, which, has its pros and quite a lot of cons, I would say.
Yeah, sure. So I think in the original news article and the original press release, it seemed like they were using an assertion that Cayman house prices had appreciated at a faster rate than other investments that are made within the pension plan over the last 10 or 12 years. Maybe, do you want to just speak to the veracity of that or how that might have been misconstrued or confused?
Yes. This is really problematic, I think, Adam, in that there was a statement by someone in the government that you would be better off, or you would have been better off over the last 10 years having invested in Cayman property versus investing in the US stock market. Now, we've got the figures for the US stock market. We know exactly what's happened there in the last 10 years. And I looked up before I came on, and I think the S&P 500, which is the broad measure of the US stock market, the 500 biggest companies in the United States, that index stood at something like 1,600 10 years ago. And today we're at, you can tell me, 4,300?
Yep, thereabouts.
So 1,600 to 4,300 in 10 years is what you could have made that by just buying the S&P 500, which you can do today very, very easily and pay almost no fees. So you would have got that return. I don't think there's a single property in Cayman, even if you'd bought prime property on the beach. Maybe a few small pockets, would you say, in Cayman where you might have got close to that return, but not net once you take out your costs of owning that property.
Right.
Has any property in Cayman gone up by, that's almost 11% a year for the last 10 years, taking out your costs. Remember, all your transaction costs when you bought it, when you sold it, your strata payments along the way, your upkeep, your AC bills, the AC fixing. You take all of that out and you haven't come close. And I think the average house price in Cayman, not prime property on 7 Mile Beach, the average house price in Cayman hasn't come anywhere near close to generating that kind of return. And we wouldn't expect it to, because property doesn't appreciate in the same way as owning bits of businesses appreciates over the long run.
Yeah, it was a funny comparison to use to motivate this decision because, really U.S. equities have been the best performing global asset class over the last 10, 12 years.
They could have picked any other asset class and that might have been the case, but U.S. equities have done so well. And I think part of the problem here is that the pension regulations are very strict around what and how the pension plans can invest, and they don't have freedom to just invest in US equities. Mm-hmm. So they haven't been just invested in US equities because the government set pension regulations that said that they couldn't. So therein lies another problem. They have to own a certain proportion of bonds in there, which is the lower returning yet lower volatility asset class. That, we could argue the merits of having that asset class in a pension plan, till we're blue in the face, but they haven't been able to just invest in US equities, and neither should they, because there's a whole world out there and they should be globally diversified. But yes, you're right. It was a very strange comparison and factually, unfortunately, quite incorrect.
Yeah, it really was a strange blunder because U.S. equities, I think, have compounded at 3 or 4 times the rate of any other global equity market and bonds over the last 10 years. So, choose any other market, Europe, Japan. Actually, Japan's been on a nice run recently, but U.S. equities have really stood out. And the other thing I think it reflects is maybe a little misunderstanding about just the general mechanics of how markets work, right? So, if markets have gone through a decade of sort of, which they haven't, but if they had gone through a bit of a decade of churning sideways and not delivering spectacular returns, like many global markets have, not necessarily U.S. markets, and certainly as bonds have over the last 2 or 3 years, that typically reflects that markets have gotten cheaper and that the forward returns that we can expect from a diversified global portfolio have actually gone up in terms of expectation, right?
Yep.
So, it's a strange attitude to sort of say, well, past returns over the last decade in pensions have been weak, which I think is probably not true relative to real estate, and therefore we should pivot to real estate. When real estate is expensive and potentially a diversified global portfolio is less expensive, and therefore the relative expected returns favor a diversified global portfolio over real estate, maybe.
Absolutely. And let's just think for a minute the difference between having all of your net worth or, your family assets in one home in Cayman versus having some in that home and some in this globally diversified portfolio of what we call equities, remembering that that is bits of businesses. People always think they own casino chips when they own equities or stocks or shares, same thing. But you own bits of the most productive, successful businesses on the planet. And you can own, thousands of those businesses really, really easily today, which you do through your Cayman pension. Now, that is incredible and diversified. And we know it's going to go down, but we know it can never stay down because those businesses can never all go bust together. And then you think about the one home in Cayman. And, we could work through several scenarios in our heads that have some possibility of happening. I'm not saying they're probabilistic, but they could happen. We could have a couple of really big storms this year. We get to the point where insurance is almost impossible to get. There's a whole host of things that could mean that that one property doesn't maintain its value. And that's why it's so important to not have that old adage of all your eggs in one basket, which is really what happens when you have everything in your home.
Yeah. No, I think we could probably agree that the relative merits of investing in your home or paying down your mortgage change a little bit over time as interest rates, for example, change and the price of homes fluctuate, right? So would you say that it probably makes a little bit more sense today to be paying down more on your mortgage on a relative basis? Because interest rates are much higher.
Absolutely. Absolutely.
Right.
If you're paying 9, which most people are, let's say roughly 9% on your mortgage, you can kind of think of that as a guaranteed 9% return if you pay down your mortgage. It's not quite, but there's a good enough way to think about it. And then you look at what else you can do with your money. And yes, over the long run, US equity markets and global markets have appreciated by a little bit more than that. But we can't say for sure what's going to happen with global markets. Whereas if you put it into your mortgage, you can say, okay, I can sleep well tonight knowing that I've effectively made myself a 9% return by paying down my mortgage. I think that is very appealing. And there's great merit to people paying down their mortgages quickly in this kind of environment.
Yeah, right. It's just more of I think the challenge that you and I struggle with knowledge of the long-term returns on global markets versus just real estate in general, is the assertion that because we've had a period of poor returns, which in markets, which we haven't, that we should be pivoting to make a very substantial withdrawal from our global market portfolio to redeploy to this concentrated leveraged investment on this little island in the middle of the Caribbean with all of those commensurate concentration risks that really work at direct odds with one of the primary objectives of prudent investing, which is diversification.
And the other problem with it, Adam, is that if you get to retirement and you have your home paid off, that's amazing. But where is your income coming from? You can't live on your home. Well, I say that. I mean, I grew up in a household where my parents had to live on their home, and we always had lodgers in the home, and they did bed and breakfast, and they made an income from their home. But that's not normal.
No, exactly.
And so people have to realize that generally your home does not provide you an income in retirement, and that's a big problem.
Yeah, no, agree. So thanks, Georgie. We're going to take a break and then come back with some more perspective on this.
The Cayman Islands Chamber of Commerce Pension Plan. Become a member today. With 6 flexible life cycle funds, we help you plan for financial security in retirement. We keep our members informed with the plan's performance through quarterly fund fact sheets. We have an all-in expense ratio of 0.75%, over 16,000 members, and 337 million CI dollars in assets under management. If you would like to join or require further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. Become a member today. Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
All right, we're back. I thought it was maybe useful to review the historical context for global market returns, both equities and bonds, relative to the historical returns on real estate in most countries, right? And I mean, granted, we have gone through a period, depending on the country, of pretty spectacular gains in real estate. Certainly if you live in Australia or Canada, and in certain parts of the United States or Britain, for example, real estate has been on a tear recently, or over the last sort of 10, 15 years. Obviously, the U.S. market had a major correction in the 05-06 timeframe. And it's, I think, difficult for people after going through a period like this with a lot of headlines about how real estate has paid off to take a longer term perspective on the relative returns to real estate versus other potential investments. Do you want to sort of take a longer term view for me, Georgie, on the relative merits there?
Yeah, I mean, it's hard in Cayman because people say, yes, but Cayman's different and we don't have long-term data here. So all we can do is look at the US perhaps, or the UK. But the US is where we've got the longest running data set for property prices. And if we look at something called the Case-Shiller Index, which is an index of US house prices going back to, I believe, 1920 something. You can correct me, Adam, if I'm wrong here. I think it's appreciated something around just over 4%, maybe. Is that right?
Nominal, yeah.
Yeah. So inflation has run at about 3.8% over that period. So a little bit over inflation, but just barely over inflation is the long-term price appreciation of houses in the US.
That, of course, takes into account the cost of financing a home, the cost of maintaining a home, the cost of property taxes and stuff in most other countries, right? I mean, we pay higher costs for servicing a home, et cetera, and for hurricane inflation, et cetera.
And transaction costs here. The getting in, the buying of the house, that's 10% for most people, 9-10% up front.
Yeah, absolutely. So, net of all of these extra costs, homes typically have appreciated at approximately the rate of inflation over time, right? Now, there are merits to owning a home regardless. You carry a risk. You and your family need to live somewhere, right?
Absolutely.
And for a typical family, shelter costs typically amount to somewhere between 30 and 50% of your total cost of living, right? So you do want to take steps to hedge the risk of the cost of shelter accelerating or, growing at a rate that's above the rate that you're growing your wages, for example, right? So there's certainly merit to being able to hedge some of those risks.
And there's a great psychological benefit of owning a home. For a family to have a home that they grow up in, that's their home, and they can do what they like with their home. I mean, there's something to that. Absolutely.
I mean, it's habitual for us to think about things in terms of the spreadsheet numbers, right? How do the numbers work out, and maybe ignore a little bit the lifestyle and emotional and family-oriented benefits that come from
the ability to create memories with your family in your home.
Yeah,
that's an investment in many ways.
That's a really good point. So, notwithstanding those benefits, Let's compare the long-term performance of owning a home to owning a diversified global portfolio, maybe of, global stocks and global bonds. What does that look like?
Oh, that's more like 10 to 12% per annum over the last 100 years. That's a really big difference. Multiples. We haven't got the chart in front of us, but we have the chart of what that does to $1 over 100 years. When you compound that money, it's huge.
Yeah. So nominal returns to global equities. So nominal returns sort of are the returns that you typically see on your statement, right? And don't include the headwinds of inflation, right? For global equities have been sort of in the neighborhood of 7-8%. For U.S. equities, they have been a little higher, right? And for bonds, they've been in the neighborhood of, call it 3-4%, right? Depending on the duration and the credit quality of the bonds. So any way you slice it, a diversified global portfolio in expectation is probably going to produce higher growth for you. If we're just looking at the pure numbers, seems to be a better choice long term than orienting all of your savings towards paying down a home. I think we both agree that the relative merits change over time, as we did discuss. If we're facing 3.5-4% interest rates, probably the relative amount of savings that's being driven towards a global diversified portfolio relative to paying down your mortgage shifts relative to when you're paying 8, 9, 10% on your mortgage. But over the long term, even if your mortgage payments or your mortgage interest rates are in the 8, 9, 10% range, pulling a substantial portion from your diversified global portfolio to pay all of that down on a mortgage probably is an overstatement of confidence in your local housing market.
And the other point we haven't touched on actually is pulling it out. You're pulling it out at a time when it's down, because we're down in the markets. I mean, we've had a great run, but we had a really bad time last year, as has been discussed on this show, across all asset classes. And although we've had a really strong recovery since the beginning of this year, we're not back to where we were before. So we're still off those highs. So you're pulling. So there's an opportunity cost to that, because you're pulling your money out of this globally diversified portfolio, possibly at a time when it's, having this wonderful, what we call rally, on its way up again to reaching all-time highs.
Yeah, you're right. And, again, what we know about markets in general is that when they go through a period of malaise, sideways chop, typically the global economy continues to grow, and the corporate sector continues to churn out profits. And if the corporate sector continues to churn out profits and grow their profits over time, now on a real basis, companies have grown profits at about 6% real over the very long term. So, these profits are growing over time. The prices that you're paying for a piece of those profits, remember, we're owning a basket of global businesses. The price you're paying to own shares in those businesses is flatlining, or in this case of the last couple of years, has gone down. Now you're having to, or you're able to pay less for a growing pot of profits, right? And so in expectation, we would expect to get higher returns on those investments going forward than we would expect if we had, continuously been paying more and more per unit of those profits over the last little while. So this may be a particularly prospective time to be reallocating towards. And also, let's keep in mind what's happened to bonds. I mean, let's reflect on where bonds were a year and a half ago versus where they are today.
Yeah. Well, we've got amazing yield you can get now. So forward returns now are higher. Although the price of the bonds that you have owned has gone down, the forward return on those new bonds has gone up, because what we call the yield, so that the cash you get back from owning that bond has gone up to, between 4 or 5%. A year ago, it was almost nothing.
Yeah. What do you say to investors who are concerned about inflation and who perceive that home ownership may be an effective, consistent hedge against inflation that maybe stocks and bonds might struggle against?
That's a great question. I mean, property is a decent hedge against inflation because it generally, over the long run, has kept up with inflation. But equities are an even better hedge against inflation over the long run. They've been incredibly efficient at preserving your purchasing power. That is, what your money can actually buy. Because businesses, and again, remembering that you own a bit of a business, when you think about what a business can do, a successful business, as their costs go up, what do? They generally pass that cost on to onto their customers by putting their prices up. And therefore, businesses are able to mitigate the impacts of inflation as a whole. And that is reflected over the long run in the share prices of those businesses. Businesses don't sit around, just letting inflation eat away at their profits, because businesses are fairly rational beasts as a whole. And they're always, as you alluded to, seeking profits. And they will do whatever they can to continue to maintain profits and increase their profits over the long run. And so they're an incredible hedge against inflation over the long run.
Yeah. The other thing is, in theory, because most people borrow in order to buy a home, home prices over time should be relatively sensitive to interest rates, right? So the price that somebody will pay for a home when interest rates are sort of 3% is very different than the price that somebody will pay for a home when interest rates are 8%. Now, it used to be when the price of a home was a smaller multiple of one's income, that had a lower impact, right? So for most of history, home prices were, in the range of sort of 2 to 3 times a person's income. Nowadays, home prices tend to be sort of 5, 6 times a person's income or higher. The way that we got here was that interest rates went so low that the bank could buy the home, and the cost of paying your monthly payment went lower and lower and lower as interest rates dropped, right? So the leverage that you have against your home, in other words, the amount of money that you need to borrow to buy your home, has gone up dramatically over time. And what that's done is it's changed the relationship between inflation and the rate of change in home prices. So that it used to be, I think, that home prices could be counted on to be a reasonable inflation hedge. But nowadays, home prices are so linked to the cost of financing, to interest rates, that relationship actually may have flipped. Because as inflation goes up, of course, mechanically, interest rates also go up. And as interest rates go up, then the value of the things that you're funding with those interest rates goes down, right? And so it's possible that positive relationship between home prices and inflation may be broken in this sort of modern financialized economy that we live in.
And therefore, we may not see the returns on property going forward, certainly in the Cayman Islands, that we have in the last, let's say, 10 or 20 years.
Yeah, and I think we can also say that the Cayman Island economy and Cayman Island real estate, probably in particular, is more levered or more sensitive to the performance of global asset prices in general and the ability of people to borrow and get lending, not necessarily because, or maybe partly because we need to borrow in order to buy homes here, but also because the financial sector in general, on which Cayman relies relatively heavily, is also heavily reliant on the availability of credit, the growth in the total value of assets worldwide. Keep in mind, the fund sector on island earns a fee on the total value of global assets. So if the total value of global assets declines by 10%, the fees that we're getting on those assets also declines by 10%. And the Cayman economy is much more sensitive to that dynamic than most economies. And that's another potential dynamic that may impact on home prices.
I think people just need to be very cognizant that the returns going forward on property may not be what they have been in the past.
Yeah, and not use that as a gauge of what to expect going forward. Yeah. Great, Georgie. Well, this has been very productive. I think it's a timely issue, and thanks so much for sharing your insights.
Thanks for having me.
The Cayman Islands Chamber of Commerce Pension Plan, we're here for you. The Chamber Pension Plan is asking for all members to ensure their member details and contact information is correct and up to date. To review and update member details, simply visit chamberpension.ky. Log into your account and provide the necessary information for your personal profile and for your beneficiaries. For assistance in updating member details, call us at 745-7630 or email admin@pensions.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan. Become a member today. With 6 flexible life cycle funds, we help you plan for financial security in retirement. We keep our members informed with the plan's performance through quarterly fund fact sheets. We have an all-in expense ratio of 0.75%, over 16,000 members, and 337 million CI dollars in assets under management. If you would like to join or require further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. Become a member today.